Thought leadership from PwC's National Office.
Hi, welcome to PwC's Accounting Podcast. I'm Kyle Moffitt, PwC's professional practice leader and your guest host for this SEC Focus series. We've been taking a back to basics look at key areas of SEC reporting. And today's topic is one that often raises a lot of questions, and that is pro forma financial information. These are the kinds of requirements that can feel straightforward until you're in the middle of a deal or filing, then the nuance really starts to show. Today, we've got you covered with an overview of when they're required, what's required, and key insights and reminders to keep in mind as you prepare them. A quick reminder, this is also a video podcast series. If you're listening to the audio-only version and want to watch the video, just head to the show notes for the link. For today's discussion, I'm joined once again by Scott Feely. Scott is our SEC and capital markets leader in the national office, obviously specializing in SEC financial reporting. Scott, great to have you back with us.
Good to be here, Kyle.
So really excited to talk about this topic today. And it's one that was near and dear to my heart when I was at the SEC, years ago, but it was 2018-19 timeframe where we started talking about, potential changes to rules, streamlining some of the rules, the requirements, simplifying the pro forma financial information, the requirements there. I actually left before the rules were finalized, but I did have some, insights into kind of what was going on. And so I think there's obviously a significant change from what the previous rules were. Sure. But I think it's important for us to I think level set and say there is a difference between what's required by Article 11 of Regulation SX, which is an SEC requirement, versus what's required by GAAP, right? And that's in ASC 805. Obviously, we're going to focus solely on Article 11 today. Obviously, if you want to talk a little bit about ASC 805, feel free. But I just wanted to tee up and kind of start the conversation with you. Let's talk about some of the types of transactions that the SEC would require pro forma financial information for.
Sure. Yep. I'm happy to do that. So there's the rules are pretty prescriptive on this in terms of Article 11. I know you made reference to it earlier. So Article 11 is a section of Regulation SX, and it stipulates a lot of things, right? One is the types of transactions that you would be expected to prepare pro formas for. It will also lay out, when pro formas are required, how do you go about preparing them? And we'll cover all of that here a little bit today. I would say for most of our listeners, there's a couple of big categories of transactions that they will most likely, be the ones that they would encounter in terms of when pro forma financial information would be required. So the first is significant business acquisitions. So a registrant goes out, or maybe somebody contemplating IPO or something like this, goes out and acquires another business, right? Pretty straightforward. There is a concept of significance that's also embedded there, and we'll talk about that.
And that's very straightforward, the calculations.
Sure.
Yeah, not nuanced at all.
Yep. So we'll talk about that a little bit in a second. We, of course, have the flip side, right, where, a company divests of a portion of itself. And that can similarly, if significant, drive a requirement for pro forma financial information. Other transactions that may give rise to the requirement for pro forma financial information include a combination of entities under common control.
Yeah.
So that's a bit less common. Situations where, a business was previously part of another entity. Okay. And, financial information or pro forma financial information is necessary to quote unquote reflect the operations and financial position of that business as what the SEC refers to as an autonomous entity. Okay. So think spin-offs,
right,
subsidiary IPOs,
right,
things like this. Yep. And then I sometimes maybe loosely refer to it as the catch-all in Article 11. Okay. And there's a provision that says, if you have other transactions, whether consummated or probable, for which pro forma information would be material to investors, you have a bit of a catch-all that allows you to provide pro forma financial information in those circumstances. Okay. And there's a handful of those that are set out in the FRM.
The FRM, and keep in mind too, with the FRM, that has not been updated.
That's true.
In a number of years. And so it doesn't necessarily reflect, the current rules themselves, but I think as far as the practice that, involved, right, the expectation from the SEC is you still would kind of apply it similarly, you're just going to use the new rules, but the events that are listed would be something you would reflect pro forma
Exactly. So the FRM which is the SEC's interpretive guidance and manual, hasn't really been updated for the new rules, which, as you said, were issued in 2020. So they're pretty outdated at this stage in terms of what's happening in practice. But I would say the scoping of Article 11 and what types of transactions are require pro forma financial information, that didn't really change when you went from the old rules to the new rules. And so we think certain provisions that are captured in the FRM continue to have relevance. Okay?
What's your team seeing? Like, or what types of things are they seeing? Like, I know one thing that we've talked about in the past is bankruptcy, transactions, right? And kind of that impact. But what else are we seeing companies do or need to do pro forma reflection of the financial statement?
Sure. Yeah. So bankruptcy is a big one. It's relatively common. It's spelled right out in that section of the FRM. We think about bankruptcy similar to an acquisition, right? In the sense that you have a change in basis, and it makes sense to push that back to the first day of the earliest period presented. Again, this is a pretty broad concept, though, right? And it sort of puts the onus on the registrant to say, if you think pro forma financial information would be material, there's a lot that you can capture there. So some other examples may be repayment of debt, changes in capitalization at effectiveness or close of an IPO, tax conversions. I've had questions, Kyle, around push down accounting, right? If someone elects optionally to apply push down accounting under GAAP, would that be something? We look at that very similar to bankruptcy, right? Change in basis, that probably is captured here.
No, it's interesting. I think when we actually covered this something similar, we alluded to this in our one of our previous ones that will air prior to this one, and it's on the capital formation and it's kind of the process, the IPO process. And I think those couple of examples are great examples of things that the staff would expect to see in a registration statement. These pro forma disclosures for can change in the nature of the business, the entity, change in capitalization. So I think those are really great points to highlight. You mentioned significance, right? And I know that we talked about it, and we don't need to go into too many details on it because I know it's pretty nuanced, but can you just at a high level talk about kind of size of the transaction? Like what's going to trigger the requirement to present pro formas?
Sure. Yeah. So you will recall from what we were just talking about that this concept of significance is embedded in a couple of places in terms of, scoping of when you need pro forma financial information, most notably acquisitions and or divestitures. We are going to do a bit of a deep dive in another podcast in this series around mergers and acquisitions. Okay, given the nature of when significance comes into play, maybe for purposes of this podcast, I'll just say that when measuring significance, there's three tests. One is the investment test. There's an asset test, which is assets to assets, and then there's an income test. Again, there can be a lot of nuances when you get into the mechanics of doing these tests. What's really important is that it's the highest of those three, right? So you're simultaneously going to run the three tests, and it's the highest outcome under any of those three that will dictate. Okay, right. And then I would just say that for purposes of this podcast, the threshold to keep your eyes on is 20%, right? That's generally the line between significant and not significant.
So if you hit standpoint, just in the income test, if you hit 25% financials, you're going to have to provide the pro formas for a particular transaction, potentially financial statements too, right? So,
correct. Exactly. And there's no, if you're at 19.9, you're out. And if you're at 20.1, you're in. You're in. Exactly.
Yeah. And I guess the other thing, and I guess just curious your perspective on what's the most challenging of the three that you typically see people just kind of, is it the investment test and kind of how to do that calculation? Are there any nuances there? Or even the income test? It seems like the asset test sounds pretty straightforward, but the other two, I think historically, I would see that was usually the challenging ones of just applying that, right? But
yeah, I think certainly in terms of, anomalous outcomes, I would say the income test used to generate the most anomalies, and that's for obvious reasons, right? Income can be the most volatile of these metrics, and if you start talking about putting a pretty volatile metric, especially in the denominator, you can see your way to pretty anomalous outcomes pretty quickly. Again, there's a lot of nuance here. There's actually two legs to that income test, okay? Because one of the problems that the SEC was attempting to solve in this 2020 rulemaking was to eliminate some of those anomalous outcomes. Okay, that they were getting a lot of letters that were arguing.
We were getting a lot of letters
Exactly.
when I was at the staff.
Exactly,
Yeah.
that were arguing that the outcome of the test was anomalous. It wasn't really indicative of the significance of the transaction to the registrant, and a lot of times, what registrants would use to argue their case would be an alternative metric like revenue, okay, which is a bit more stable. And so there's actually two legs to that income test, and it's the lower of those two that then feeds the higher of the three. It can get a little bit messy, but I would say the income test probably has the most nuance embedded in it.
Yeah, I think you're right. So type of filing, as you alluded to this earlier. Whether you have to, file as certain events occur, right? You do have 8K reporting requirements within 4 business days. You're reporting events or transactions. Talk about kind of the types of filings we see pro forma financial information in.
Sure. Yeah. So you hit a little bit of this. So certainly event reporting. So Form 8K, that's obviously for existing registrants, and that is all triggered off of consummation of a transaction. Okay. That's important when you're delineating between the Form 8K and maybe some of what I'll broadly call transactional documents. We're going, again, in this series, we're going to have a podcast specifically on 8K reporting. So some of my colleagues will go deep on that. But again, it's tied to consummation, and there's a requirement to certainly file an 8K within 4 days of consummation. And then depending on whether it's an acquisition or a disposition, you may or may not have more time to get pro forma financial information on file. We'll cover that here in a second. The second, maybe broad type of document where you would expect to see pro forma financial information is in what I'll call transactional documents. Yeah. Okay. And that might be registration statements. It could be proxy statements or information statements. And here again, that will get covered in the capital raising podcast. And so we're going to focus on the building, the preparation of pro formas as opposed to, going deep on, when they're going to show up in a particular document.
Okay, so let's assume you have to prepare these pro forma financial information. What periods are required? I think kind of start there.
So I'd say the baseline for the vast majority of transactions, the baseline is that you need the latest.
I love it's always the vast majority, although there's always an exception when it comes to the SEC.
There's always
which
exceptions.
I love.
These exceptions in this case, they make sense. They make sense. I'll explain them here in a second, but they do make sense. In most instances, you're going to need one balance sheet, and that will be the latest balance sheet that is otherwise in the document or on file. It can be an interim balance sheet or an annual, but you're only going to need one balance sheet. And then you're going to need the latest annual period for the registrant. And then to the extent that they have a year-to-date interim period, you'll use the most recent year-to-date interim period. Okay, so one, possibly two, depending on timing during the year, income statement periods.
Yep.
Right? One annual, one year-to-date interim. I did say in certain circumstances, you might have a different outcome.
Right.
Those are really two different situations. And in that situation, you're going to need all 3 years, right? Rather than the latest annual, you're going to need 3 annuals. Those two situations are divestitures that are going to be accounted for as discontinued operations and common control transactions. And the underlying logic is that in each of those cases, those transactions will eventually be accounted for fully retrospectively in the GAAP financial statements. Okay. And so by preparing 3 years of pro formas to the extent that it's not already fully reflected in the GAAP financial statements, what you're really doing is giving the reader a preview of what those historical financial statements are eventually going to
look like.
Exactly.
Yeah, right.
Exactly. But absent fully retrospective GAAP accounting treatment, you're going to have the latest annual period plus an interim. And then I was just going to hit one other nuance here, which is in acquisition scenarios, you sometimes run into a fact pattern where the year ends don't align. Okay, the year end for the registrant, the year end for the target.
Which is always fun. That's another wrench.
Exactly. Exactly. And so registrants often wrestle with, well, how do I do this, right? Do I need to force the target onto the registrant's calendar, or, is there some provision in the rules that would allow me to do something different? And, in those fact patterns, similar to what you might, see in some areas of GAAP, there's some allowance to combine periods on up to a 93-day differential. Okay. And so, if the target has, just to keep it simple, a September 30 year end, and the registrant has a December 31st year end, you could potentially look at combining those periods because they're less than or maybe just equal to 93 days different. Okay. And so it's a practical accommodation that can simplify the process where you have non-aligning year ends. Okay. You
see that a lot? Do we see that a lot?
I would more than I would have thought. So when I was out in the practice, I had a sense that it didn't come up that frequently. And, like a lot of things, when you sit here at National, you see a lot more. You don't go as deep on everything, as teams would in the field, but, you see a lot more. And so this fact pattern comes up more than I would have previously thought, I guess I would say.
So as it relates to what I always think about with respect to the pro forma financials, form and content. So obviously the rules address it. When you talk high level kind of, obviously the one thing I always think about is the introduction, right? Like the description, like, what's the transaction that you are reflecting or providing pro forma information for, right? What entities are involved? If you have, company A and company B are merging, how are you thinking about, which entities, how you're reflecting the transaction, the periods, providing an explanation of really what it shows, but talk about what those look like.
Yeah. So normally with a traditional set of pro formas, and I'll talk about scenarios where you may not see this format, but normally with a traditional set of pro formas, you see some introductory text that will cover a lot of the things that you mentioned. Okay, so it'll sort of describe the transaction, it'll describe the GAAP accounting that's going to be applied to the transaction. It will speak to the entities that are involved. It will explain what periods you've combined, maybe going back to this situation where you have non-aligning year ends. And it will give the reader some context for what pro forma adjustments are being shown. You'll then have, typically again, the tabular presentation in the middle, and we'll talk about that in a second. That would then be followed by, again, typically a series of pretty detailed footnotes that explain each of the adjustments that are reflected in this tabular presentation in some detail, including typically with, setting out the assumptions that have been made and deriving those adjustments. In certain instances, maybe setting out sensitivities so that readers can understand, if an interest rate moves by 1/8 of
the thought that I was thinking right there, right?
Exactly.
The impacts of a difference in interest rate or whatever, variable interest rate, potentially what the impact would be.
Exactly. So that's the general format. In some, I would say, limited circumstances, there's some provision in the rule that you don't actually have to do a tabular presentation. But it's not really common.
I've seen it a few times, but not a lot.
Yeah, you don't see it a lot because the situation where it would apply is generally pretty narrowly scoped. So, think limited adjustments from a pro forma standpoint. They're easily understood and I'll call it isolated, meaning, they impact very few line items exactly on the P&L. The situations where I've seen that, acquisition of a non-controlling interest. Okay, so it's already a consolidated subsidiary. You're taking out an NCI. Pretty easy to understand that. I've also seen it in situations where a company is divesting of a business, but it was reflected as a discontinued operation in their historical financial statements. And so they're left with a handful of adjustments, we call it to de-recognize the assets and liabilities from their balance sheet, recognize the proceeds, and maybe push a gain or loss through. Okay, it's pretty limited, pretty easy to understand. So I've seen a few registrants, take that approach in that scenario as well.
And I don't think, and I've not seen the staff comment and say that that's not an appropriate approach to take. I mean, I've seen, not to say that the staff's looking at every, let's say, 8K that's including pro forma financial information. They may not be reviewing it, but I think by and large, like to your point, if they are, the nature of the adjustments are pretty straightforward, you're probably going to accomplish it with some sort of narrative disclosure.
Exactly. Yeah. But that should be really for very narrow fact patterns. It should be obvious.
Yeah.
Okay. Like when you say the SEC hasn't commented on it, it could be that they just didn't pick up that 8K.
Right.
But it could also be that the situations that we're talking about here are so obviously simple that they're likely not going to be the subject of a lot of debate. So I was going to hit a couple of other things on structure. So one is that, from a P&L standpoint, you go through income from continuing operations and income from continuing operations attributable to shareholders of the registrant. Most important point in there is that if you have discontinued operations, those are coming out and they're not being reclassified down to the discontinued operations line. They just come out in their entirety. And then maybe one other fact pattern that, again, isn't the most common fact pattern, although we did see a lot of it with a particular class of transactions recently. And that is, situations where, there are multiple possible outcomes to a transaction that's being contemplated. And you sometimes in that fact pattern, see registrants present multiple, what I'll call multiple sets of pro formas with, most recently we saw it in the de-SPAC craze, where we were talking about redemptions and you saw a low end redemption scenario, a high end redemption scenario. And in certain circumstances, we saw a midpoint or a best estimate or something like that. Again, it's not the most common outcome, but in situations where there are multiple possible.
You can expect the staff's going to see that and issue a comment. To the extent it could change, they absolutely would potentially see a comment there. I guess my question for you is just follow on is where does this go in the document? Like, so if it's in a registration statement, like, what's the location of it? Does it go in the financial statements? Like maybe you can clarify that where it needs to reside or where we typically see it reside in the document.
Yeah, of course. So every once in a while we'll see it, added to the, what I'll call the F pages, to the very back of the document, certainly outside of the historical financial statements. It has no impact on the historical financials. Every once in a while we'll see a registrant put it into the F pages. They think, it's financial information, it's pro forma, not historical, but let's put it back there. So we'll have the historical financials and then a separate entry in the index for pro formas. But most commonly, maybe almost universally, it's in the front part of the document, right? In the front part of the document. So somewhere in and around MD&A, you'll have a dedicated section of, registration statement that will have the pro forma financial information.
So we in our kind of capital markets or, talking about the IPO process, we talked a little bit about comfort letters. Sure. What type of comfort, or at least you don't need to get into the details of it, but is that information that typically, people are asking for comfort from the auditors on?
Certainly. Yeah, undoubtedly. Auditors will be asked for comfort on that. I would say there's two types of comfort in that fact pattern. So, the pro formas are anchored to historical financial information as a starting point, right? So when you start thinking about that tabular presentation, the far left column is going to be a set of historical financial statements. Then you're going to apply pro forma adjustments to that to arrive at, I'll call it simplistically the far right column, which is the actual pro forma financial information itself. So again, two types of pro forma comfort that might, be requested of auditors in that fact pattern. So banks, underwriters may come along and ask for circle comfort on the historical financial information. So circle the column, tick or tie it back to the historical financials, either annuals or interims included elsewhere in the document. The second element of comfort would be, again, I sometimes speak simplistically, but I'll call it the blanket comfort, which is negative assurance on the pro forma financial statements taken as a whole, right? Negative assurance is, nothing came to our attention that caused us to believe that, the pro forma information is not prepared.
Similar to like what we do with review procedures.
Exactly.
Yeah.
Okay. So there's two aspects to the comfort, in certain situations where, an acquisition, for example, you may have two audit firms involved, right? So the registrant may be audited by one, the target may be audited by another. And so there'll be two comfort letters. Only one will provide the negative assurance over the pro formas as a whole, but each of the firms may be requested to circle their respective.
And this is why it's important to know that information, right, is going to be looked at. This is why the auditors will look at that information and review that information because it is definitely relied upon in transactions. And so you keep talking about adjustments. And so I think back to what the old rules said about the nature of the adjustments, kind of what the parameters were. And essentially it was, factually supportable, directly attributable to the transaction itself, expected to have a continuing impact. So three things that in practice were pretty difficult to kind of apply. And so I think, we have a different construct in this rule. Can you talk a little bit about the three buckets of adjustments that companies can actually or should be looking to and thinking about as they're preparing pro formas?
Sure. Yeah. And this was all newly created in the 2020 rules. So you did have the old three criteria. Some of those, well, they've all really gone away. Some of those concepts still live on a little bit in the new rules. But you didn't really have different categories of adjustments, okay, like you have in the new rules. And I would say that, these changes, by and large were positive, right? They moved in the direction of detaching from, factually supportable, I have a contract, to a model where you say, what's really useful for investors, right? And if I don't have a contract, should that really stand in the way of me putting information, that's going to be helpful to the decision-making process. So three types of adjustments. These are the only types that you can contemplate. Okay. So they have to include.
So don't make up another adjustment is what you're trying to say.
There are
We've
no
seen
other,
that.
there are no other categories.
Right,
there are no other categories. Right. Okay. So the first is transaction accounting. Okay. And these are maybe the simplest of the lot, right? And this is, you go and you do GAAP accounting for whatever the transaction is start with your balance sheet. So if it's an acquisition, go do my purchase price allocation. If it's a divestiture, derecognize, those assets and liabilities. Once you do the GAAP accounting on the balance sheet, then take the impacts of what you just did to the balance sheet and flow them through the income statement. Okay. And on the assumption that the transaction closed on the first day of the fiscal year that's presented. Okay. And so these transaction accounting adjustments, again, most common in acquisitions and divestitures. You certainly see it with financings, so on and so forth. Second big category of adjustment is what they call autonomous entity adjustments. Okay. And remember that one of the categories of transactions that we talked about that would prompt the requirement for pro forma financial information was where an entity was previously part of a bigger entity, and pro forma financial information is required to, show that smaller entity on an autonomous entity type basis. So that's what this contemplates. Depending on how some of this gets interpreted, this leaves a lot of, room for judgment, right? Because this is really intended to say, I'm a spinco or I'm a subsidiary that is going public via IPO. And, I was previously part of a much bigger parent who is sponsoring, this separation transaction. What is it going to take for me to run this business on a standalone basis, right? Do I have to go out and establish all kinds of corporate functions, whether finance or legal or risk management or, executive functions, so on and so forth. So that's the type of stuff that these autonomous entity adjustments contemplate. And
they're not perfect. It's not a perfect science either, right? Just trying to figure out what the calculation would be. Like when you think about, and I guess like as you're saying all this, it sounds to me, and maybe you can confirm it with the data or what your experience is, like are we seeing most of the comments from the staff, or at least the areas that really seem to be more challenging in that autonomous entity adjustment space? Obviously, it's not every single transaction is going to have those types of adjustments, but to the extent they do, it seems like almost every time I've seen them or worked on them, that they always have comments on them. Mm-hmm. Yeah,
always. Yeah, and I would say, because you can think about the comments in two different ways. So, we're into an area where there's a lot of judgment, okay, which might, prompt comments from a regulator, but it might also be pretty difficult, to challenge, right? Yeah. It's like, this is a judgment that I've made. And so it really comes down to, having a process in place to build out, these cost estimates. And, as you might expect, when you get into a big area of judgment, disclosure can become pretty important around how they were calculated and things like this, so that the registrant understands, the investors understand the basis upon which these adjustments have been prepared. I would say the second maybe line of questioning that you see from the regulator as it relates to autonomous entity is, it can get a little bit gray in terms of where the line is between autonomous entity and this next category of adjustment, which are management adjustments.
Yep.
They're treated very differently from a pro forma standpoint. And so the delineation becomes pretty important. And we've certainly seen regulatory focus on that delineation.
Well, and here's the thing, right? When there's a lack of kind of, a lot of detail. I mean, this is all principles-based types of disclosures. When doesn't have a ton of very specific, like do this, do that, right? You're going to have differences in practices across registrants, and of course, maybe even accounting firms. But certainly the staff, right? The staff may have a view reviewing your filing that it's not an autonomous entity adjustment; it's a management adjustment, and that nuance may matter. And so why don't we go to that point of management adjustments? And I guess my first question to you before we dive into kind of what they are, and do we see a lot of companies doing management adjustments? Because I would say when I was reviewing filings as part of the SEC and capital markets team, I would see these those, but very rarely. You wouldn't see them that often. Are we seeing people utilize them more now, or is it kind of the same as kind of the experience I had in the past?
Yeah. So I'm going to answer that question, but before I do, I'm going to go back just one step because I think it's important to draw out what we're really talking about here. Autonomous entity adjustments are presented on the face of the pro forma financial information. Okay, and so when we're building far left to far right, autonomous entity adjustments and transaction accounting adjustments are going to show up in the middle, and they're going to be reflected in the derivation of that far right column. Management adjustments are a third category of adjustments. They're completely voluntary. Okay, unlike those first two, if you're in that situation, you have to prepare adjustments in those first two categories.
Choice. Yep.
Management adjustments are completely voluntary. If a registrant, which is inherent in your commentary, okay, if a registrant chooses to prepare and present management adjustments, they are limited to presenting that in the footnotes to the pro forma financial information. Okay. And so they can't go on the face of the pro formas and I'll call it be embedded in that far right column, right? That's not permitted. So let me do one other thing, but what are
people are probably thinking, why? Why is it not permitted?
Right.
And I think we'd say prominence is always an issue with the staff, right? And it's also, we're not talking about numbers that, like, when you see the actual financial statements moving forward for the company, the historical financials, they will somewhat mirror their pro formas. When you think about purchase price accounting, the adjustments, right? You expect to see that incremental expense for, let's say, PP&E depreciation, right? But as it relates to management adjustments, it's what are management adjustments? Yeah.
So, and this is the crux of it. So management adjustments reflect synergies and dyssynergies of the acquisitions and dispositions for which pro forma effect is being given. Okay. And so if you have an acquisition or a disposition, obviously acquisitions most commonly, a big portion of that rationale has to do with synergies. Maybe if you have a divestiture, there will be some dyssynergies involved because you're getting smaller. Maybe your purchasing power goes down, something like this. So I would just say that, as we think about these three categories of adjustments, whether it be transaction accounting adjustments, autonomous entity, or management adjustments, as we move through that continuum, they get progressively more judgmental or oriented towards projection.
I think that's a great way to describe it.
Yeah.
Yeah.
And so from both a regulator standpoint, but I would say also from a registrant standpoint, when this rulemaking was happening, there weren't a lot of registrants who were enamored with the idea of being forced to present their estimated synergies in a tabular.
Sounded like you read the proposing release and the adopting release.
Exactly. And so that's part of why, maybe a big part of why we landed where we did, which is these are voluntary. And if you're going to do them, they go into the footnotes.
What types of management adjustments do you see? Like, what are you seeing them in practice?
I would say they're not that common.
Really?
Okay, so in certain spaces, it's maybe not uncommon to talk about them in some way in some
you
documents.
may expect synergies from an acquisition. You may talk about it elsewhere, but you may not be comfortable enough maybe to put it in some sort of adjustment in your pro forma.
Exactly, right? And so at least from my standpoint, it hasn't been, there haven't been that many situations where registrants have, availed themselves of this ability. I would say, going back to the point we made earlier, Kyle, in terms of this gray space between autonomous entity and management adjustments, there have been situations in spinoffs, for example, where there have been some questions around whether projected costs are autonomous entity adjustments or are they dyssynergies, management adjustments, so on and so forth. I have a view on that orients to the fact that, from a SpinCo standpoint, you're neither acquiring nor divesting. And so personally, I sit and think, I'm not sure there's a rationale to explain why they would be management adjustments. But that said, that's not how everything has played out in the marketplace. And so when we do see management adjustments, I would say they're most common in, Form 10 spin documents,
right?
Okay, where registrants, perhaps have been precluded from presenting something as autonomous entity adjustment that they really think is important for investors. And so they go to this third alternative, which is to present them as a management adjustment.
That was great. And I think you did a really nice job of kind of highlighting what each adjustment is for. We've already mentioned touched a little bit on this, but I'd like for you to kind of just summarize for me the prohibitions, or for the audience, the prohibitions on presenting pro formas. I mean, obviously, we talked about you're not going to throw them in the financial statements, so they're not going to be presented in the face of the historical financial statements. But what other prohibitions are there that the SEC has embedded in this rule?
Yep, yeah. So there's a handful. I would say the biggest one was historically there were some I'll call them special situations. Going back to the FRM that is yet to be updated, there were some special situations that required the presentation of some pro forma data in the historical financial statements, right? Side by side with some of the historical information, et cetera. When this new rule came out, there was a prohibition built in that said, unless it's required by GAAP, so think ASC 805 pro forma information required by GAAP, unless it's required by GAAP, you shouldn't have pro forma financial information either on the face of your historical financial statements or in the notes there too. Okay, so that was a big prohibition, which caused some of the historical practices where pro forma financial information was actually included in the historical financials to migrate to the front part of the document. You're also prohibited, once you remember that. This is pretty prescriptive in terms of the whens and the hows that we've covered up to now. And so one of the prohibitions, which seems pretty commonsensical to me, is, you're prohibited from presenting pro forma financial information that doesn't reflect everything that's in the pro forma financial statements themselves. And then I would say maybe the third, and this maybe feels a little bit similar to non-GAAP guidance when we get into prominence and things like this, but you can't present pro forma data that's been adjusted for management adjustments. Okay, think projected synergies, without presenting side by side with the baseline pro forma that reflects, remember, only transaction accounting adjustments and, to the extent it applies, autonomous entity adjustments.
That's a great point there, and I think certainly could be one that people might lose sight of. So you talked earlier, and I'm just thinking about companies going through implementation, and you spoke about only presenting through continuing operations, on the income statement. In your experience, I guess, the SEC's requirement versus what do you see companies doing, if it's any different, columns, transactions. So let's say you have multiple transactions, how should that be dealt with?
I would say the rules are pretty clear on that, right? That if you have each transaction ought to enjoy its own column in the pro formas. You can envisage scenarios, in a simple scenario, you're pro formaing for one transaction, but that's not the real world. Okay, there are plenty of situations where we're pro forma-ing for multiple transactions simultaneously, and so it can get messy.
Don't you love how we've made up all these words, pro forma-ing?
Yeah, turn it into a verb.
Dyssynergies, which the SEC, like I was assured when that rule was being proposed that dyssynergies was in fact something that we could utilize when I was at the staff. Not sure I've seen it used at all before.
Yeah, there can be questions. Okay, we get into a business combination, and I've got financing related to that business combination. Right? Does that technically require a second column? I think maybe pure technical view, people probably say, yeah, it's probably a different transaction. But I would say practically, again, because those adjustments on the financing column are generally pretty easy to understand, they impact a couple of line items. You most commonly see them, put together in one column. So there's a little bit of room for interpretation.
Look, I think to your point earlier, it's all about disclosure.
Mm-hmm.
And in that introductory section where you're teeing up the pro formas themselves, right? That's where you talk about this is what we've done. This is how we've presented it. And shouldn't be any surprise when somebody flips the page and starts to look at the tabular disclosures, the pro forma financial information, the sets of those financial statements themselves. You should be able to understand what is being presented. So I guess the other piece here, which I think is also one that we always say to people, be mindful of tax impacts. So can you talk a little bit about that?
Sure. Yeah. So on tax impacts, I think we sometimes see registrants who want to go straight to, pull the effective rate from their rate rec footnote in their historical financials and apply that to the pro formas, and off they go. I think the guidance is pretty clear, right? That you start with a statutory rate when you're pro forma-ing. Here goes that verb again. Okay. when you're coming up with the pro forma tax impact of pre-tax adjustments, the starting point is statutory rate. Okay. It doesn't mean you do it blindly. Okay. If a company is in a full valuation allowance position, you're not going to tax affect something at 40%, and let it flow through to the bottom line, right? You're going to think in a little bit more of a nuanced way about it. But again, the starting point is statutory rate. I want to go back to one point on the columns.
Yeah.
Okay. If I can.
Yeah.
Because you sometimes see an interesting scenario where, a company has to pro forma for discontinued operations. Recall that we said that that's a 3-year requirement when we talked earlier. And they may have either in connection with the divestiture itself, they may have other things that they want to pro forma like a TSA. It could be that they have a discontinued operation 3 years and an acquisition in a registration statement. Have to be really careful that just because discontinued operations are being pro forma'd and require 3 years, it doesn't create allowance to pro forma any other transactions for more than the latest year. Okay. And so in those situations, you'll see pro formas that are built for the most recent annual period that will handle the discontinued operations and then go on to handle, let's say, an acquisition. Whereas in the 2 earlier years, it will handle the discontinued operation and it will stop there. So I just wanted to make sure we hit that.
I think that's very helpful because it's important for people to know that, form and content matters, right? And, when I think about like takeaways, from this session itself, before I get to, your takeaways, I think about it's important to always look at the form, what the form tells you is required. Look at the rule itself. So look at, Article 11 of Regulation SX, understand what's required, but then also, I think benchmark, look at other companies' disclosures of similar transactions. Talk to your advisors, I think is always key. It's critical. But I think that the thing that you mentioned earlier, which I really liked, was it was very clear that you've read the proposing release and the adopting release. Mm-hmm. And there's a lot of nuggets embedded within that. Sure. And it's something that working on the rule, the really smart people at the SEC and CorpFin that actually worked on this rule, they really spent a lot of time thinking about all these nuances. And so I think it's really important that you do look and you're grounded in the rule itself. What are your takeaways? Or hopefully I didn't steal.
No, not at all. Not at all. I'll make up another one.
Okay,
it's no problem. I think maybe I'll go up, and I think those are great reminders. I'll go perhaps a little bit of a different direction. I'll just say that these concepts that we talk about with pro formas and pro forma financial information and some of the underlying concepts, they're pervasive, right? Yeah. So we talked a little bit here about the build of the pro formas, but maybe I'll just encourage our listeners to this podcast to also switch on, because of the integrated nature of Proformas, to get to the M&A oriented podcast, the capital raising podcast, and also the Form 8K podcast, because these concepts are going to weave themselves through all of them.
Yeah. So Scott, really appreciate you taking the time. I know this is definitely an area that you probably spent a lot of time on, we get a lot of questions on, and I think just really shed some light on kind of best practices, and appreciate you taking the time, and look forward to participating in other podcasts with us.
Happy to do it, and thanks for having me.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.